Hi everyone and welcome to today's morning report on Friday the 8th of May with me, Rich Perry, market analyst at Handtech Markets. The European trading session started very positively. Certainly the FTSE 100 is up, and the big reason is because the UK general election has come out with a very surprising Conservative majority victory, and that has given a significant boost to sterling and UK equities. The market was not expecting this in any way at all. The opinion polls were certainly suggesting a hung parliament with no overall control, and it is a bit of a surprise, it has to be said, and markets are still reacting to this. Cable is up over 200 pips now, and it's very strong still on the day, so significant moves here we're seeing in the UK equities. It's not necessarily going to be the main driver of the day as we go on. I think markets are going to settle fairly quickly as we look towards this non-farm payrolls report, and the non-farm payrolls are the key factor that we need to look out for today. But first of all, what I'll do is I'll show you this is the dollar index, and we've had a slight rebound actually in the dollar in the last 24 hours, and you've seen a bit of a turnaround in sentiment in the States. You've seen bond yields falling sharply actually. Let me just show you the Treasury yields actually hitting a high of just above 2.3, and you've seen that sharp move intraday yesterday and a bit of a rebound from today's low, and also what you've seen is a sharp fall in the oil price. That oil price though, however, has, if you read my morning report, has formed support above the 58.30 level of support that was fairly key near term, I believe, in that WTI price. So a couple of reasons why you've seen a bit of a turnaround in sentiment in the States. You saw the S&P 500 finding a bit of support, rising higher by about 0.4% into the close, and also the dollar just regaining a bit of ground. But certainly I think that markets are going to be fairly cautious into this non-farm payrolls data that comes out this afternoon. Certainly looks to be the most important, well, is the most important bit of data out today. As we go on, 224,000 is the expectation according to Reuters. However, in light of that ADP number that was on Wednesday that showed a disappointing fall and miss of expectations on the ADP employment report, the private payrolls suggest that maybe non-farm payrolls could again be a bit disappointing, and possibly the rebound from 126,000 last month may not be as high as 224, so watch out for that. So this dollar rebound that we've got at the moment may be short-lived. However, markets are likely to be cautious in front of that data this afternoon. Not a great deal else out other than that, so watch out also for, in that payrolls report, you've got the the average hourly earnings, 0.2% on the month, which would be pretty much in line with the year-on-year data that we've had for the last couple of months, about just above 2% on that year-on-year earnings growth for the average weekly earnings. And unemployment data is expected to fall again to 5.4%. So that is the expectation in the jobs report. That takes me to my chart of the day, which is the Swiss franc. Now, this Swiss franc has actually formed having had this correction over the past 3-4 weeks, bit of a sell-off. You've actually seen the first really positive candle for a while on this dollar Swissy. And you've seen a bit of a hammer candle, a bullish hammer candlestick, and that is the, as I said, the first real sign of a possible rebound on this chart. I think it's probably going to be a bit of a near-term rebound because you haven't really seen any major pickup in the momentum indicators yet, but you have seen a slight uptick in the stochastics. If you see that confirming a crossover buy signal, then perhaps you could engage a bit of a recovery. And what you're probably looking out for is the initial resistance, and that initial resistance, I believe, would be Wednesday's high. If I show you on the intraday chart, you can get more of a gauge of this. So you've got Wednesday's high, which was the initial resistance, and that sort of also encapsulated the 1st of May low. So you got Wednesday's high around 92.80. That comes in if you get it bang on. And also, if you look on the daily chart as well, the real resistance that you need to break through would be the rally high from that bearish outside day, which was the 94.13 mark. But that also comes, if I get the crosshair going on the daily chart, that also comes just underneath all this key resistance here around 94.70 area. So there is a fair amount of resistance near term that would hold back a rally, but it could be a bit of a near term bounce. You've had this then the RSI back at 30. You could well see that unwind, and anywhere towards sort of 50 area looks to be where recently, certainly during this sell-off period, that the RSI has been falling over. So maybe around the 50 area would be where it could unwind to, and you could well see in the coming days the Swissy unwind back towards this resistance area. I think at that stage you would then start to think about whether it is a continuation of that rebound, or that would be just almost arguably a pullback rally before further downside. But certainly near term it looks like that bullish hammer candlestick pattern has just improved the outlook near term. Anyway, I wish you good luck in your trading on the Swissy today. As per usual, the payrolls report should well produce a bit of consolidation, but then likely significant volatility in the aftermath. So I wish you good luck, and I'll speak to you later. Thank you.